Time now for today's strategy session. Trump tariffs, a lingering concern for the global investors, but our next guest says focus on equity fundamentals as a buffer to those risks. Joining us now is Young-Yu Ma, who is the BMO Wealth Management US Chief Investment Officer. Great to see you here in studio with us, and thanks for taking the time just after the opening bell. As you think about the characteristics that should really framework the investor's mindset around fundamentals right now, what are some of the pillars to that?
Yeah, thanks, Brad. It's great to be here. I think if we look at those pillars, it's important to take a step back because there could be disruptions related to tariffs this year and other policies. But the importance of fundamentals is to give us an understanding of what the buffer is, how much the economy and the markets can sort of absorb and disruptions that can be managed and worked through. And we see that both the consumer and corporations right here as being in a very healthy spot. Spending has been healthy. Neither consumers nor corporations are highly levered. And oftentimes when you get to a point which is considered maybe mid or later cycle, leverage starts to build. We don't have that now. So there's a good buffer. But you add on top of that these AI trends, the spending trends like Jared was talking about, additional capex by these hyperscalers and productivity gains that we think are going to start to kick in this year. We think the backdrop is pretty positive, and those fundamentals can withstand a lot of bumps along the way this year.
When you take a look at the fact that the market's off to the best start that we've seen under a new president since 1985, since Reagan, I guess will very much some of the sentiment be put to the test next week when you take a look at big tech earnings and how much is riding on the handful of those results?
Well, a lot is riding on them in aggregate because they have such a large weighting in the index. You know, if we're thinking about the whole year, though, I think what's more important is to see what's the data and what are the anecdotes that come out of the typical companies, the average companies in the S&P 500 and the Russell 2000, and how are they implementing AI? How are they getting benefits from some of this? So, you know, these mega-cap companies are such a large weighting, you can't not focus on them. But I do think that the story this year is really going to be more about how these trends are permeating throughout the typical company.
And what do you expect to see on that front?
I think we're going to see a lot of news about how companies are using and implementing new technologies and AI to really enhance productivity, to be able to grow without adding much to their costs and their bottom lines, to find ways to improve the efficiency of their workforce, and that helps margins, that helps profit growth, that even allows for greater wage gains. Productivity is really a type of a silver bullet. You can have your cake and eat it too, in terms of getting this growth, but also getting health, stability, and wage gains for employees.
It's two-pronged, right? Because there is of course, investor mindset that says, all right, how much of that is already baked into the shareholder value and the returns that I've seen there because you've seen the wave of investments from companies who are beneficiaries of B2B spending. But then also it's an economic issue too on the front of, okay, well, that productivity also means that there might be less need for labor force participation, or at least the same scale of employees that we had in previous cycles of labor force participation. How do you kind of balance that?
Yeah, that's right. That's a good point because as we get more productivity, the need for, if we can get that growth, but that growth might not need as many new workers in certain areas, or there might be shifts, right? You need workers in some areas more than you did in other areas. The good news is we're approaching that stage, or approaching this sort of disruptive period at a very low level of unemployment. So we're not at a point where the labor market is fragile or is prone to cracking, or the consumer spending is sort of starting to wobble here. So we're approaching it from a very stable standpoint. We are going to get disruptions. That's what new technologies do. So I think that's part and parcel with what the economy has to work through, but fortunately we're in a good spot to handle that.
Are there sectors that would be most likely to experience those disruptions earlier on and kind of, you know, lead out in front of some of those disruptions?
Well, I think the financial sector has been talked about a lot, you know, but there are a lot of industries. You know, the legal industry is starting to implement AI a lot as well. The healthcare industry in terms of drug development. You know, there's a lot, middle management in general. There are a lot of areas where new technologies companies are looking for new technologies to help that middle management layer be more efficient, perhaps not need as many workers in that space. So, you know, I do think it's very broad-based, but certain sectors are more on the forefront for sure.
All right, Young-Yu, thanks so much for taking the time to join us here in the studio.
Thank you.